So for UOB, we have upgraded to buy. Our target price now is $34.50. Previously, it was $31.70. So the improvement in target price was due to higher ROE assumption. Previously was 11.1%, and our FY18 earnings forecast is revised upwards by 6.1%. So the positive for UOB this quarter, NIM shrunk by one basis point quarter on quarter, but excess funds are expected to be deployed effectively to raise net interest margins back up to 1.84%. And this is also supported by 2 more Fed rate hikes. And also loans growth jumped to highest in almost 4 years, which is mainly broad-based. And internationally, Greater China was the standout with a 36.9% year-on-year growth. The third positive is that credit cost has also declined. There was an aggressive provisioning last year in second quarter, so ECL actually declined 50% this quarter due to a recovering oil and gas sector. For the negatives, non-interest income declined for the first time in 6 quarters. And this is mainly due to wealth management fees that retracted because customers are turning to be more risk adverse due to uncertain market conditions. And also net gain for investment securities declined due to a one-off gain on disposal of investment securities last year. And so the second negative is that the expectations were rife about higher dividend payouts for UOB. And this quarter, we saw that it was slightly below the dividend payout ratio of 50%. And also, this might in turn be a letdown in expectation of higher dividends for the fourth quarter because capital might be diverted to fund initial large IT expenses of the new digital bank franchise. And also, due to market uncertainties, management has become more vigilant in deploying capital. And also they have put forth that they will invest more capital in raising net interest margins back up to above 1.84%. So all in all, the rising interest rate environment, together with higher loans growth and elevated net interest margins, will continue to drive growth for UOB for the rest of FY18. Moving on to OCBC, we have also upgraded to buy, and target price is unchanged at $14.90. So the positive for OCBC, net interest margin expanded 2 basis points year on year, and this was driven by overall loans growth, and also internationally, Greater China was the outperformer at 16.1% year on year. A high single-digit guidance by the management is maintained. And also improving asset quality, allowance declined due to heavy provisioning last year, and credit costs also declined by 14 basis points to 5 basis points this quarter. And this underwhelming credit cost is expected to normalize from the 5 basis points to 15 to 20 basis points for the entire FY18. So even though management gave a higher credit cost guidance for the full year, there are no problematic loans portfolios right now. For the negative, net interest margin for OCBC was surprisingly flat for the past 2 quarters when other banks saw improvement in their net interest margins. So this is because the higher net interest margin in Singapore and Malaysia was offset by weaker NIMs from Indonesia and Hong Kong. And also other non-interest income fell mainly due to a fall in net gain from investment securities, but this fall was offset by a spike in net trading income where 40% belongs to the mark-to-market portfolio in Great Eastern's account. So overall, earnings for FY18 will be boosted by loans growth, net interest margin expansion, and also low provisioning this year. So the upside in NIM might be capped off by Indonesia and Hong Kong's inability to raise pricing. So that's all for me. I'll pass on to Paul.
Thanks, Minin. I'll move on. This is on Asian Pay TV. For Asian Pay TV, all our worst fears were snowballed in these results. Firstly, we had a dividend cut for FY19, not this year. This year's dividend still at 6.5 cents. Second negative was that the subscribers declined. This is the first time in several years that we've seen such a large decline of pay TV subscribers of 2,000. And the third negative was that they've guided capex to be higher. As you know, the past 3 years capex was high because of as they were digitizing their set-top box. But the next 2 years, they said that the capex will still remain high because they are looking for fiber rollout in order to increase the broadband speeds from 500 megabyte to 1 gigabyte. Anyway, the only positive we got from it was about the broadband subscribers grew. As you know, broadband is the highest margin product because there's no content cost involved. That continues to grow for the third consecutive quarter. Just to reinforce the dividend cut again for FY19, they've not actually mentioned the amount, but they just said that it needs to be sustainable and it needs not, and they do not want to gear up to pay the dividend. So our estimate is about 3.5 cents. Okay, and just to, if you look at the chart, the reason why we downgraded was, as you know, if you look at the revenue and EBITDA, this is the core part, it continues to decline. 2.5 percentage points of it is due to currencies. But if you see a continuous decline in revenues due to lower ARPUs and lower subscribers, it's very hard to offset this or turn around this so long as we continue to get lower subscribers and also pricing. So that was the main reason why we turned negative, and that we do not see any turnaround in the revenue or EBITDA in the near term. Okay, I'll move on to the next. This is Siong. The results came out earlier, but just that we had no time to present, so I'm just presenting it now on Siong. The title is just Fresh Products. Okay, for Siong, the main highlight was on the gross margins. Gross margins continued to hit a record high. It's about 27.5%. The reason for the record gross margins is mainly due to their fresh products. Fresh products as a group has about gross margins of 34. But the challenge for fresh products is that it's always harder to handle, and you in a way need some skill at least for the staff to handle such products because of the limited shelf life. Fresh products here refers to, as you know, fruits, vegetables, and fish and poultry. The other positive was that there were new stores, and the growth on the top line also came from new stores and also their same store sales growth. The one negative was operating expenses. As you can see, there was a slower growth at the EBIT. This was due to as they expanded new stores, 4 in the first quarter. This kind of raised their fixed costs. We can consider this as upfront costs. As you know, when you set up a new store, before the revenue comes in, you need to pay the rental and labor before the eventual sales comes in. So we're not too worried about this and consider this more upfront. Okay, and we maintain our accumulate. The two main stories why they're doing well for Siong, apart from the gross margins, is that on the top line, they're gaining market share from the wet markets as they sell more fresh products. And also they're gaining market share from the mall-operated stores. One way to monitor, as they highlighted, as if you look at Capital Mall Trust slides, there's usually some description of the sales of supermarkets there. So supermarket sales in the at malls, which is your cold storage and so forth, I think the revenue growth there is about 1%, whereas as you can see, Siong is growing about almost 6%. So they're taking share. One last point would be on the impact of e-commerce. The company just reiterated that the impact is mainly on the bulky items, which you are referring to, your usual beer, diapers, and so forth. The impact is mainly on those types of products. Okay, that's it for me. Move on to Richard.
Thank you, Paul. So ComfortDelGro announced their 2Q results last Friday. We published our report this morning. We maintain accumulate for ComfortDelGro, and we have increased our target price to 278 from 269. Our dividend forecast remains the same, 10.4 cents, and that will give you a 4.4% yield based on last Friday's close. So as you can see in the table, revenue is higher by 5.4% year on year. That's about $48 million higher, and of this 48 million, 47% of it is from new acquisitions, and the rest is from organic. So the underlying increase of 46 mil was aided by favorable currency translation of 1.8 mil. Going down the line to operating profit, it's 2.1% lower year on year. That's because of 6.5% higher operating expenses, and these 6.5% higher operating expenses outpaced the 5.4% revenue growth. And then lastly, for PATMI, it's down 5.5% year on year. This is due to higher non-controlling interest from higher SBS Transit profit. So just a reminder, ComfortDelGro owns 75% of SBS Transit, and SBS Transit had a good quarter this year where they recorded about 53% higher profit. So based on that, there's a larger non-controlling interest that has to be subtracted out from the ComfortDelGro group P&L. And so that's why you see the PATMI margin shrink from the EBIT line, because EBIT is full consolidated, but PATMI is after minority interest. So we go into the positives now. Public transport services segment benefited from 52.9% year-on-year higher profit by SBS Transit. This was because of Seletar bus package and the provision of some of the shuttle services when the MRT stations closed early and open late. And then there's a high ridership on downtown line following the opening of downtown line stage 3. The next positive is taxi segment stabilized with a more rational competition landscape. The fleet idle rate was 2% during the quarter, and that's lower than the 3 to 5% range during FY17. Also, older taxis were scrapped, so that helped to match supply of demand, and then it also aided to rationalize costs for the taxi business since they lowered the number of idle taxis. For dividend, they have declared a 4.35 cent interim dividend. This is the same as last year, but you will notice that EPS is lower this year. So they've been able to maintain it because of their strong cash flow. For first half of this year, they generated 10.1 cents per share of free cash flow compared to 5.3 cents per share last year. Now move on to the negatives. There was an increase in OPEX, which outpaced the increase in revenue, and this resulted in margin compression for EBIT from 12.5% last year to 11.6% this year. Management alluded this to the transitional integration costs for their new acquisitions. So this should be temporary, but at the same time, we think that the transition of the Northeast Line to the new rail financing framework also contributed to some of this margin compression, because the new rail financing framework has a profit cap and collar structure and limits EBIT margin at 5% compared to the old model where EBIT margin was in the mid to high teens. Next is that goodwill has increased by 16.4% year to date as a result of the acquisitions. So now goodwill accounts for 10.5% of total assets. That's significantly higher compared to the 10-year historical average of 5.5%. This increase in goodwill is an effect of their organic growth strategy, their inorganic growth strategy, and we estimate that it will rise to 11.7% by the end of this FY. And then lastly, inventory build up. So we see that inventory has built up on the balance sheet as well. By percentage of total assets, it's crept up to 2.7%, which is almost double of the 10-year historical average of 1.5%. So this inventory build up, they explain, is in preparation for midlife maintenance of their buses and rolling stock. So this, what we see is that This could lead to a negative surprise of higher than expected maintenance-related expenses in the coming quarters. Overall, outlook for ComfortDelGro is positive. Second half of the year expected to be stronger than the first half. Firstly, we talk about the organic growth. There's a full 6-month contribution from the Seletar bus package in second half of this year compared to the partial contribution this year, first half of this year. And then there will be the continued moderation of downtown line losses, and as well as a taxi business which has stabilized. Also for inorganic growth wise, they come from 2 sources. First is the contributions from the acquisitions done in the second quarter. And then they've already announced the pipeline of acquisitions that they are currently in the progress of completing, and these should start contributing in the third quarter of this year. And now we move on to Guangzhi.
Okay, thank you, Richard. So next, I will talk about the Sembcorp Industries second Q results update. So we maintain our buy call with a lower target price of $3.70. So you can see the results here. The top line grew substantially. That was mainly due to the contribution from the marine segment as well as the turnaround in utility segment. So for the utility side, the Singapore market and China market continue to perform well. You can see the net profit from the respective market grow moderately. So I need to highlight here is the Indian market. So you can see this quarter is a big turnaround for the India operation. From last year's loss making to the current quarter's net profit of around 40 million Sing dollars. So you can see the big turnaround was mainly due to the improvement of SGPL, one of the thermal plant in India. You can see the last year SGPL lost around 39 million. However, this quarter it turned around and make 8 million net profits. And also the plant load factor also improved substantially for SGPL. So moving forward, we think that the India operation will continue to improve, and we expect that next year it will have a higher profit contribution. So for marine side, we already briefed the second Q updates. So from our point of view, we think that the marine segment will continue to track the whole group's performance because the net order book for Sembmarine continue to shrink. So about the outlook, obviously we think that Sembcorp Industry will continue to expand its business into renewable and cleaner energy area, and also recently it acquired another UK company called Power Reserve. So we think that the UK side it will have another net profit to book in next year. So the Sembmarine's recovery is longer than expected. So I know we think that the improvement of the whole group's performance will slow down onwards. Sorry about the typo here. Here should be okay. So for China Everbright's second Q update, we maintain with our buy call with a lower target price of 53 cents. So you can see the figures here actually improve moderately. So the positive side is that in the second Q, there were 6 wastewater treatment projects securing tariff hikes ranging from 1% to 165%. And also the group received a one-off of 20 million Hong Kong dollars retrospective tariff adjustment. This was due to the delay payment from some of the projects. So the negatives is the Zhenjiang Sponge City project was postponed again. Previously, the management expected the project will be completed by end of this year. However, due to some pipeline network issues, it is still waiting for the authorities' approval for some inspections. So the project's completion will be expected in next year. So for the outlook, as of 2Q this year, the total wastewater treatment capacity arrived at 5 million tons per day. However, the group already previously set the target of 10 million tons of daily wastewater treatment capacity by 2020. So based on the current organic growth, which is the upgrading of the existing projects, is around 10 to 20% per annum. So it is quite difficult for the whole group to achieve this target. So the management may seek more project acquisitions moving forward, which is inorganic growth to achieve this target. So we expect there will be more project acquisitions within the next 2 years. And also in August, the group applied for the dual listing in Hong Kong. According to the management, they think that the Hong Kong investors are more familiar with the business model, and also quite a number of peers are listed in Hong Kong. So they think that being listed in Hong Kong will have a higher valuation and as well as liquidity. So next is the China Sunsine Chemical 2Q update. We maintain our buy call with a lower target price of $1.77. So you can see the results here. Actually, 2Q was another record quarter for China Sunsine. The top line grew substantially by 34% year on year, and the bottom line was more than double compared to last year. So the outperformance was mainly due to higher ASP as well as the sales volume. That was because during 2Q, the shortage of supply of rubber chemicals continue in China. That's why China Sunsine can enjoy such a high GPN and MPM. The negative side is that the new capacity is expected to commence by 3Q this year. So previously, the management expected that the approval will be granted by 2Q. So that is the biggest uncertainty for China Sunsine. So for the outlook, since 2Q, the results was so outstanding, and we do check the underlying raw materials price, the aniline. So over the past 1 month, the aniline price started to correct, and that was because some of the exporters to US shifted back the aniline exports back to the domestic market. That means there will be more supply of aniline in the market. So the price of aniline started to fall in July and August. However, we think that Sunsine can maintain its gross profit margin at more than 30% in the second half of this year. And the catalyst for China Sunsine can to maintain its performance is the new capacity. So hopefully we think that the group can get the approval by end of this year, so that next year we can see the profit contribution from the new capacity. So another catalyst is the Battle for Blue Sky initiated by the central government. We think that this plan is will be a short-term negative impact, but a long-term beneficial driver, because this Battle for Blue Sky means that there will be more inspection on the environmental protection facilities. So that means these kind of inspections will cause quite a few of disruption on the operation. However, from the long-term perspective, it will gradually phase out those disqualified and small, medium-sized and small players in the market. So as a leader, as an industry leader, China Sunsine can consolidate its market position so that it will enjoy the stable market share. So this is the end of our Monday webinar. Next session is Q&A.
Hello, there's a question. What is overseas contributions to ComfortDelGro results? So overseas is about 40% for revenue and 40% for EBIT. This is you can find this in their PowerPoint presentation slide.
There is a question asking about China Sunsine, why the share price keeps dropping, and is it due to shortage? And also ask where is the location of the hotel that China Sunsine owns. So why the stock price keep dropping? Because in the near term, we think that second Q is the peak for its performance. So you can see the aniline price started to fall, and for China Sunsine, they just like maintain the gross profit margin at about 30%. So that means if the aniline price continue to drop, the ASP also will be in line with the aniline price. It's like a cost plus model. So you can also see the crude oil price started to correct recently. So we think that people are expecting that the next quarter's results or the second half of this year will not perform as well as it did in the first half. But still, we think it is undervalued. So maybe because the recent market emotion that caused the price drop so much. So the hotel China Sunsine owns was in Shanxian. So for more details, actually you can find it in the last year's annual report. Thanks. Another question is regarding China Everbright dual listing. What will be the impact for the Singapore shares? Obviously, if China Everbright can get a higher valuation in Hong Kong, That means the investors here may transfer the shares to Hong Kong and sell it. So that means we'll drive out the liquidity in Singapore even more. So we think that this will be the first impact we expect. There is also another question asking about China Sunsine's competitors' performance. One is Yanggu Huatai and the other one is Tianjin Kemai. So for Yanggu Huatai, because it is a listed company, so the top line, the revenue grew by 44% to 1.5 billion RMB, and its net profit grew by 172% to 220 million RMB. So in terms of the growth, roughly China Sunsine and Yanggu Huatai are the same. So for Tianjin Kemai, because it is not a listed company, so we may we may not know the actual performance. So we don't think that this will be a threat to Sunsine's market share, because actually for this industry, the biggest threat is the more stringent or tighten control on the environmental protection, which is initiated from the central government. So actually, as a market leader like China Sunsine, this is good for China Sunsine, because the more and more SMEs will exit the market, and China Sunsine's market share will be consolidated moving forward. So actually, we think Sunsine can maintain its performance as long as the new capacity to kick in as soon as possible. Thank you. Another questions regarding to Sembcorp, asking about whether we can give an update prospect on marine industry. So as of now, we do see that the utilization rate of the offshore facilities is improving and increasing. However, the day rates are still soft. So we think that it will take longer than expected for marine industry to recover, because a lot of these vessels are still oversupply. And for oil majors, they are quite cautious on the capex in the near term. So as long as they don't inject more capital or significant amount of improving capitals into the industry, the marine side will still continue to maintain at the current level. Thank you. So if there are no more questions, we'll end today's webinar. Thank you for tuning in. We'll see you next week. Thank you.